Hello, and welcome to Finance Concepts by your Finance-ista Cynthia Bush. Today, we're going to talk about the private markets. And the first thing you should know is that this is not a physical place, but this is a space where large institutions, angel investors, and venture capitalists go for investments. If you'd like to learn more about angel investors or venture capitalists, please see my videos on those topics. So the investor base in private markets is relatively narrow, very targeted and focused. And the securities that are traded in these markets are sold to a limited number of investors, a few hundred or less, sometimes just a handful. In fact, in the US regulator, the Securities and Exchange Commission, requires companies in the private markets to file public disclosure documents, which they hate, if they have too many private investors. Currently, the limit is 2,000 or more. So the issuers in the private markets are entities like businesses and governments who are looking for longer-term financing. These issuers can be less established companies, which is probably the bulk of the private markets. Those companies would not be familiar to the average person, but are very well known to investors in the private markets, like your venture capitalists and angel investors. But also, we can have mature public companies who will issue in the private markets. And there are lots of well-known, very large private companies who like to issue in the private markets, including Mars, which owns Skittles. So this chart gives you an illustration about the fact that there are a number of very large private companies. This chart focuses on the United States, but there are lots of large private companies and small ones around the world who like to transact in the private markets. So this chart shows you Ernst & Young, Mars I've already talked about, Publix grocery stores, PetSmart, Bechtel, etc. Now let's turn and look at private market investors. As I said before, it's a narrow targeted investor base who participate in the private markets. It includes entities like CalPERS Retirement System, Fidelity, Vanguard, and TD Ameritrade, insurance companies like Allstate, well-known angel investors like David Lee and the angel investors on Shark Tank, and well-known venture capitalists like Sarah Kunz and the government of Saudi Arabia. These are all potential private market investors. So distribution in the private markets can be direct or indirect. And by distribution, I mean how securities are bought, sold, traded. Direct private market distribution is when a company on its own goes out looking for investors and convinces them to invest in the company. That is direct distribution. An analogy to that would be if you were to go to Starbucks, strike up a conversation with someone, and invite them out on a date. Between the two of you, you agree on the time, the place, the location. That is a direct transaction. Indirect private markets distribution is when there's a middleman involved. So an analogy would be in the personal space, when people use Match.com or Tinder, that's an indirect distribution model. In a professional space, investment banks are the matchmakers, and I've got a chart that shows you some of the more well-known ones here. And they are matching the issuers, the companies who need financing, with potential investors, entities who are looking to make the financing. Private markets are lightly regulated. Very few required governmental filings in the US, and both issuers and investors like that. However, it's not completely the wild, wild west. Issuers are supposed to be truthful, but the investors are expected to be sophisticated enough that they can do their own due diligence. As a reminder, these securities are not available to the general public. Now, in addition to private equity securities, which trade in the private markets, you also have private debt securities. When I say private debt, I mean companies are looking to borrow money. They can do so in the public markets or the private markets. In the private markets, some of the advantages are ease of execution. The company can work with the lender in this private space and they can tailor a financing or a borrowing that meets the needs of both entities. It can be a much faster process because there's very few governmental regulations that need to be adhered to. And in some ways, it can be cheaper than if the company goes and borrows money in the public markets because there are fewer regulatory requirements and sometimes lower fees. There are disadvantages, though, to borrowing in the private markets. For one thing, there are restrictive covenants. These are lender requirements to whoever is borrowing the money. And sometimes these covenants can be more onerous for the borrowers or the issuers than the covenants that would be required in public borrowings. Additionally, these securities are illiquid, which means that if they want to be traded, and investors do like to trade private debt securities as well as private equity securities, it may not be as easy to trade them or resell them because the market is relatively illiquid. Sometimes the issuers or the companies who are borrowing the money in the private markets will have to pay higher interest costs than if they borrowed the money in the public debt markets because of the fact that the private debt borrowings are customized. So they need to pay a little bit more for that customization. So that's all on private markets. Until next time, this is your Finance-ista, Cynthia Bush, signing off.